A lot of times here on the show, I use daily charts to just talk about what happened during the day when we're doing these market wraps at the end of the day. But I wanted to step back and look at weekly data because it takes a lot of the volatility out and gives you a little bit better, clearer picture about where we are currently within the overall markets. This first chart I want to show you, and we're going to go through some of the major indexes here. We're going to look at large cap, mid cap, small cap, international, emerging markets. And you'll see a lot of similarities between what's happening not only domestically, but what's happening with the rest of the world as well. I'm going to explain to you why some of these things are happening. This first chart is a chart of the S&P 500, and what you'll notice is that really ever since the beginning of the year, while it seems like we've done a lot of action, I mean, the market's up about 5% for the year so far. Sounds pretty good, except when you look at the chart, you realize that basically we haven't done just a whole lot of anything. In fact, we've just been trapped in a fairly big trading range going all the way back to February. Now, currently, we're right here at the top of this trading range. The last time we've been up these ranges, we failed and came down to test this rising bottom trend line that's really been supportive of the markets over the last really few months in particular. But here we are once again, right here at the peak. The last time we were at this level, we thought we were going to break out of it, and that's when Donald Trump came out and announced trade wars, right? We're going to announce $200 billion worth of tariffs in China, and it spooked the markets and sent the markets back down to support. Tomorrow, here we are again, right here on the verge of breaking out, but tomorrow we're going to have really bad earnings coming out of Netflix in particular. That's going to weigh on the FANG sector, and of course, FANGs, the Facebook, Apple, Netflix, Google, that Amazon, that's what's been driving the market higher here primarily. Almost 100% of the gains this year so far can be attributed to the top 10 stocks. So tomorrow, those top 10 stocks are all likely going to get hit by Netflix's report today. So we're likely to see the market decline some tomorrow. But here we're going to just again reinforce this series of tops that has been part of this market now over the course of the last several months. This just makes it very frustrating for investors that are trying to make some gains here. This volatility in the market has really picked up this year, making it much more difficult to manage money. But this is why we've just talked about holding some extra cash. It helps reduce the volatility, but we're still primarily invested in our portfolio. So while the markets are rising, we still continue to try to keep some exposure here, but we do want to lessen the risk of a downside draw just in case something happens. But let's take a look at some of the other charts. If you take a look at mid caps as an example, so we just looked at the S&P 500, the 500 largest stocks in the S&P. Let's step this back to the 400 stocks that make up the mid-capitalization index, so the mid-cap sectors. And in fact, what you see here is a very similar picture to what you saw with the S&P 500. You've got a series of rising bottoms, and you've got a very defined set of tops that simply keep this market compressed within this overall trading range. Again, unable to break out of these tops going all the way back, very likely tomorrow. Again, we're going to fail at this overhead resistance and potentially have a bigger draw. The only outside of this is small caps, which have actually been performing the best so far. And the question is really why the small caps have been performing. Now, as you can see in our chart online and on our live stream, I'll explain this to you. But small caps have been in a very defined bull market, rising bottoms, rising tops. We just recently topped here at all-time highs. And the market struggled here just a little bit over the last couple of days, but small caps have really been where money's been hiding under the expectation that small cap stocks are basically immune from trade wars and tariffs. I will tell you that is a false statement. That is a false assumption that is going to come back to bite small cap here in the near future. Now, we're long small cap right now because it's still performing, but we are watching this very, very closely. When trade wars really impact the U.S., it's going to impact the profitability of companies. Large companies like the S&P 500, they can withstand and they can manipulate basically earnings on a very large scale basis. So if there's a 10% hike, they don't necessarily have to pass that cost on to consumers. They can absorb it in a lot of potential. It may impact profit margins, but they're so large they can absorb some of these issues that come out of tariffs. Small cap companies are very subject to profits and things that impact profitability. Tariffs that increase their costs in terms of production or services they generate, and if they can't pass that on to consumers, is going to hurt profit margins very, very quickly. So the risk really of trade wars and tariffs really lies in the small cap area. So watch that very carefully. The other area too is really looking at the international markets, because this was the belief that everybody was saying for last year. International emerging markets are way undervalued. That's where you need to put your money. And I was saying, no, don't do that, because if we get into an economic slowdown and if our economic data doesn't hold up, or you have a thing like tariffs or trade wars kick in, well, we may get a cold economically. They're going to get the flu. And really what you've seen since the beginning of the year is a complete deterioration of both international and emerging markets. Both are in a very similar downtrend. They've entered into bear territory. Crossovers are negative on moving averages. There's absolutely no reason to own international or emerging markets in your portfolio right now, because the risk economically to them is far worse than the economic risk to us, and this is already showing up in their stocks. So the whole undervalued story is fine as long as you have a globally growing economy. Right now, there is no evidence that we have global growth actually picking up steam in emerging markets or in the international sector. So protect yourself there. Come home. Be domestically allocated right now. Watch the small cap space. It's been performing well, but that's the big risk here. But keep a watch here over the next few days. This is going to be important as to how these earnings really start to come in. And more importantly, not just the earnings, but it's not just what they announce as earnings, but also it's their guidance about going forward. Listen for things about tariffs and trade wars and how that may impact their bottom line profitability. We'll be right back after the break. I'm your host, Lance Roberts. You're listening to the Real Investment Hour right here on the Voice of Texas. Don't go away.
Lance Roberts' blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.